Hello traders, this is Frank Paul from Forex Mentor welcoming you to this latest midweek complimentary video demonstration. This time around, once again for the month of February, focusing on a system that we call the Multi-Timeframe EMA Trend Trade. This is the last demonstration featuring this particular methodology before we move on to the Ichimoku trend trading methodology next month. So what we're going to talk about today is attaining a slope reading of the 10-period exponential moving average on the daily chart, examining that in relation to the disposition of the latest daily bar close. In other words, for a downtrend, we need to see a bar-by-bar bearish slope reading on the moving average. We also need to see the latest daily bar close below it. And if we can line up a reading like that, we'll trade only in that direction. Furthermore, we'll drill down to the 4-hour time frame, looking to confirm that higher level trend reading on the intraday charts as well. Very important, because a strong trend reading on the daily chart can still nevertheless be interrupted by very substantial retracement. So if you don't apply top-down analysis, even with a strong trend reading on the daily chart, you can be shooting blind and you can easily lose more often than you win, even if you're trying to put yourself on the right side of trend. So we need that strong trend reading on the daily chart. We need it on the 4-hour chart. We also need it on the hourly chart, although a very nice, simple, clear visual that we have applied specifically on this time frame is not just a single moving average, but rather a moving average ribbon comprised of the 5, 10, and 15 period EMAs. We're looking for bearish gap and angle to the latest bar on the close, or of course if we're in an uptrend, the opposite, which is bullish, which would mean the 5 EMA is above the 10 EMA, which is above the 15 EMA. There's nothing special about these period settings, but it just makes the intraday trend reading as we drill down that much more clear and precise, at least if we've got the reading that we're looking for. So if we've got all of that, then we drill down to the 5-minute time frame, looking for specifically a counter trend parabolic SAR reading, which in a downtrend would be green dots below price bars in the 5-minute, and then when that reversal happens in the direction of trend, we look to get in. And we use fairly tight stops of 20 pips. We then monitor the open position on the daily chart, sticking with the trade for as long as the trend reading on that time frame remains intact, which does mean that you will have to sort of sit through corrective rallies or corrective dips in the uptrend, as the case may be. That's just a fact of life with position trading, but that's also the way that you maximize your profit over the longer term without having to jump in and out of the trade so often. So that's kind of the approach we take. Trade review details for the chart review we're going to show you today. Euro Kiwi short bias Thursday, February 21st, 2013. Entry bar in the 5-minute chart, 5:10 a.m. GMT. Entry price inclusive of 3-pip dealing spread at 158.91. There was some noise, a very low-level retracement, which came to within 1 pip of triggering the stop before price turned the corner and headed in the correct, quote-unquote, correct direction, or at least the one that we are anticipating. Now, if it happens that price goes precisely 20 or maybe even 25 pips against you and does trigger that tight stop, I would suggest it's worth one more shot at it in the current session. I would never run the risk of being wrong 3 times on a single setup. But if after that noise, so to speak, the trend readings top down still remain clear and intact, you should assume that that second retracement is even more tradable, selling the rally in the downtrend. So it's worth another shot at it, but 2 kicks at the can, that's as much as I'll allow myself. I just don't want to run the risk of being wrong 3 times. And happily that wouldn't have been the case here, because the short signal which occurred after this retracement of 19 pips also would have got you in on the right side of the trend, which is down. As I record this presentation earlier in the week to Monday afternoon, to Monday's lows, we've seen floating profit of as much as 300 pips. And so by the time we get through with our chart analysis here, hopefully you'll have some idea as to whether you should be out of the trade by now or hanging in there expecting further profit potential ahead. So let's take a look at our charts now for Euro Kiwi Thursday last week. We'll begin with a 4-chart tiled display for the Euro Kiwi pair. comprised of the weekly top left, daily top right, 4-hour bottom left, 1-hour bottom right. Not on the screen at the present moment is the 5-minute chart, which we'll bring in just a minute. Now the weekly chart is referenced in this methodology kind of as just a simple high-level look. We don't use any of its chart elements to structure a trade, but it certainly doesn't hurt if you're looking at a downtrend reading on the daily chart to see that corroborated by something similar on the weekly. So it's not without interest that in the background here I noticed we had a swing point high for the week of January 28th, which touched the upper boundary of this upward sloping trend channel, and I've long contended, for example within the daily market flow reports for the FXM trend trader method, that this was a correction, a very, very substantial long-lasting retracement off of the low from July 30th, 2012, paralleling a similar move on the weekly chart for Euro-US itself. But the idea is that when this thing finally topped out, we should expect a pretty decisive down move. So I'll just get rid of these arrows because they don't apply so much anymore. But as we come to the week of February 18th, you can see even on the weekly chart we've got a down sloping reading on the 10 EMA, and the latest weekly bar is below that. So it certainly looks as though we had a 3-wave corrective rise to the trend channel top. Now it looks as though the euro base pairs are going down for the count. We should expect a very substantial downtrend lasting for quite some time here. So that's just a little bit of backgrounder. And on the daily chart, I thought also that there was a chance this thing could rally again. It didn't. I guess a clue of that was the fact that we had a very prominent rejection wick with the Heikin-Ashi bar plot here. What does it look like with a regular candlestick? Let's just take a quick look. Same thing. Big upside rejection wick for February 20th, the day prior. So that's not a confirmable swing point high when we come into February 21st. But if we see everything else lining up the appropriate direction, that should point us lower. So it's just a classic case of an A down to B, B up to C. C is the corrective top. At least that's a believable setup, and so the move is like this. Impulse wave down, corrective rally up. We're heading towards lower lows, and you can see that on Monday's low already as I record this for you. Okay, and one more thing we'll notice here on the daily chart, in case you're wondering what this odd looking indicator is at bottom, that's my custom projected high-low. What that does is it takes the actual high for the day, subtracts the 5-day ADR figure of 172.6 pips, and gives us a projected low at 157.57. Interestingly enough, the actual low for Friday the 21st was it was 157.55. So we came within 2 pips of getting it right. Pretty unusually lucky coincidence there. Usually we're off by a few pips, 5, 10, 15, 20 pips. Okay, so we draw a vertical dashed line now through 4 a.m. GMT for February 21st, and we have the broad outlines carried over or transposed from the daily chart down here. B was an interim bottom for 8 a.m. on the 15th at 156.43. We had a swing point high confirmed here on the 61.8 Fibonacci. So by the time we come to 4 a.m., we can see the 10 EMA is sloping down. We've got 4-hour bars below there. I'm pretty sure if we look at the regular candle. Yeah, there we go. As of the close for midnight GMT, we've got it. So that's all good. Okay, so I hope you get the idea. 10 EMA sloping down on the daily, sloping down on the 4-hour. Then we look at our custom moving average ribbon here on the hourly chart. I love this not because there's anything particularly scientific about it. It's just such a clear visual. When you've got to the latest bar close, hourly bar, the value of all 3 moving averages lower, and all 3 of those moving averages stacked bearish, that is the 5 EMA below the 10 EMA, the 10 EMA below the 15 EMA. It's just so clear and so visual. And it's only when the 5 EMA starts to slope in the opposite direction, changing from red color coding to blue, as we see here 1 p.m. on the 21st, that you say, okay, either a significant bottom reversal is happening or we're in a correction, and we're not going to look for a short trade until that reading is resolved back downwards again, which happened right here at 9 p.m. on the 21st. Okay, but as we come to right here, 5 a.m., Friday, February 21st, or sorry, that's Thursday, February 21st, we can see that we've got the kind of moving average bearish reading that we're looking for on all of the 1 hour, 4 hour, and daily charts. So let's bring in the 5 minute, and we're looking specifically for a counter trend parabolic SAR reading, which in a downtrend is green dots below price, or if yours is not color coded, at least dots below. And that happens as of 4:10 a.m. So as of 5:10 a.m., when we see the reversal from green to red, we're good to go. It's as simple as that. Okay, so the parabolic reversal price, 158.94. I'm going to assume a 3 pip stop, so I'm effectively in short 158.91. And I'm going to put my stop 20 pips above, which is right here. So let's say that you went short here, and let's say that due to differences in the price feed between a charting platform like this one, Pro Real Time, which is a hybrid feed, and your dealing platform, maybe there was even a stop trigger here. That's quite likely. If that happens, and you just corroborate the analysis you did just a minute ago, which takes literally all of a minute, if everything still looks intact, you have to assume that this pullback here is noise, and as such, the next valid entry signal should actually be that much more probable for an attempt on the short side. And so applying that logic, if you did get stopped out, parabolic reversal price here, 8:30 a.m., 8:25 a.m., 158.75, actual entry 158.72, so it's worth a second attempt. And the other thing, we have to be adaptive here. If we see that ADR is very high and the market is very volatile, 20 pips sometimes is just too tight, okay, even to withstand sort of the noise we see here. So in that case, if you have ADR of 150, 200 pips, even a 20 pip stop sometimes is not enough, in which case you might want to widen it slightly to about 25 to 30 pips. Only if you're going for a day trade or position trade objective here. If you're going for a scalp, I would never risk that much. Or at least manage the stop very, very aggressively. But in any event, we'll assume that this trade withstood a 19 pip drawdown. I've had drawdowns that came to within 0.1 pips and I ended up walking away. It does happen on occasion that price can go almost all the way and then turn the corner. Okay, so we're in short here. We've got our stop here. Another thing you can do to protect yourself, and I'm doing this a lot more these days myself than I ever thought I would, which is just to drive risk out very quickly. And so what I'd be looking for is price to move, depending on the scale of the trade, 20 pips good to entry here, allowing you to trail the stop, and then that was triggered later. But then you get in at the next attempt taking the attitude that, I need price to move in the expected direction and stay in that direction without giving me all sorts of noise like this. So you can trail your stop aggressively, drive risk out quickly, as long as you hang in there watching price action in real time for the next available entry trigger. So we're in here, 5:10 a.m. GMT, entry price 158.91. And our methodology, of course, specifies that you hang in there for as long as the trend reading remains intact on the daily chart, making it effectively a position trade, and only look to get out of the trade when that trend reading is in trouble, which would mean that the 10 EMA starts to slope up on the very first bar that happens, and or the latest daily bar closes above a downsloping 10 EMA. But there's no reason at this point not to expect that the euro base pairs will continue down for many, many weeks ahead. So who knows, this could very easily turn into a very big downtrend worth 500 or 1,000 pips, somewhere in that range. So it's worth a shot. If you take risk out of the trade, you will have that break-even stop triggered from time to time. Then you'll just try again, because we cannot predict ahead of time where the latest corrective rally will occur. But we want to definitely hang in there as long as the daily chart trend remains intact. I hope that gives you a good overview of the multi-timeframe EMA Trend Trade. It's a very reliable approach, very simple, very visual. It has you trading in the direction of trend only, which makes it a little bit easier to apply as opposed to counter-trend scalping methodologies. And I really like it. It offers up very, very good reward to risk, even if you have the odd 20 pips stop trigger along the way. We're always looking for a move of a couple hundred pips, which should really cough up reward to risk performance in the range of 5 to 1, 10 to 1, sometimes much better than that. And that is how you pay for all your losing trades and leave a really nice residual profit on the table. That's it for a review for Euro Kiwi on Thursday, February 21st. Sorry, I misspoke earlier when I was talking about Friday the 21st. It's Thursday, February 21st, just in case you want to go back and look at your own charts. And that brings us to the end of today's presentation. I hope you found it interesting and stimulated some new thoughts and ideas for your own trading approach. Next month, we'll be bringing out a new course installment focused on the Ichimoku system, which is not an indicator. It's a complete systematic approach to reading trend, finding entry signals, placing stops, trailing stops, the whole 9 yards. And that will definitely be something you won't want to miss, a completely different approach you might not have considered before. So that's coming your way next month of March. And starting next week, we'll also be bringing out our midweek video reviews focusing on that particular method. But in the meantime, please do check us out at forexmentor.com/systems lab for more information on this month's trading methodology, next month's, or any of the 12 in our series, which will be wrapping up in May of this year. Thanks again for joining us today. Bye for now.